my name is Edwin, and I'm the senior controller at Ramp. And prior to Ramp, I've worked at 3 different startups in similar role. And before working at these startups, I studied my career at PwC and EY. So today we're going to talk about how accountants can be more strategic with FP&A. For me, this is important because I'm usually the first accountant at different startup, and I have to wear 2 hats. I have to do different things. I have to build accounting, but many times they're also asking me to build the FP&A function. If you're working for a small business, if you're working for a small startup, you might be asked to do that as well. So we're really, really privileged to have Christian Waddick with us today. And Christian is the director of the Wharton FP&A certificate program, and he will share his insight and valuable knowledge with us. So welcome, Christian. Feel free to introduce yourself.
Thank you, Edwin. I'm excited to be here today. My name is Christian Waddick, and I help finance teams and business leaders develop their FP&A skills. That stands for financial planning and analysis. I'm a corporate trainer, FP&A course creator, and a director of the Wharton School's FP&A certificate program. And I've spent 15 years, so before teaching, I've spent 15 years in FP&A leadership roles, starting in consumer goods at Procter & Gamble and Unilever. And then after my MBA, I transitioned into tech. I had a chance to lead an FP&A team at Squarespace, a consumer website builder company, a medium-sized website builder company, at the time when we took the company public. It was a fantastic experience to get the CFO ready, to stand in front of Wall Street analysts for the first time. I learned a lot about telling the financial story of the business during this time. And I also realized that even though consumer goods and tech are 2 completely different industries, the challenges that people face with financial planning and analysis are actually very similar. You know, things like, how do I get better at forecasting? How do I run a collaborative budgeting process? Or how do I improve a financial model to be optimized for fast iteration? Those are really independent of the industry. And that, coupled with the fact that what I enjoyed most about leadership was helping my direct reports develop their finance skills. And, you know, that's really what motivated me to become a teacher and a corporate trainer full-time.
Thank you, Christian. I'm sure that we can all benefit from your knowledge here today. So let's start the conversation. And Christian, can you please give us like a general understanding of what forecasting, planning, and analysis is for accountant and for finance team as well?
Of course. So I'm a big fan of this definition here. FP&A is about identifying the metrics that matter, interpreting their impact on future results, and advising leaders about what they should do as a result, right? So let's unpack that. FP&A stands for Financial Planning and Analysis. And as FP&A teams, we are responsible for analyzing, understanding, and overseeing all aspects of financial operations and reporting. We use financial and operational data to plan the company's future performance. And it's really important to emphasize here that it's not, FP&A doesn't just use the data that comes out of the accounting system. We also look at what are the operational metrics, the things that our cross-functional business partners are trying to influence, because those can be leading indicators for future performance. And we analyze both past result and current trends to make projections about the future. And then we communicate that to our cross-functional business partners. And what makes the FP&A work special is that, you know, in finance, we're the only function who have access to both the sensitive financial data and the operational data. No one else in the company has that much visibility of the numbers. And so we're in this unique position to connect the dots and to make concrete recommendations, ideally, about how the performance of the business can be improved. And so the ultimate goal of when you're wearing your FP&A hat as an accountant is to help leaders make better decisions.
And how can accountants be part of that process? Like, as an accountant, how can I think with an FP&A mindset?
Yeah, so if you are an accountant and your company doesn't yet have a full, dedicated FP&A team, you're probably already doing a lot of FP&A work. Maybe you're just not calling it that. So, what I mean with FP&A is really budgeting, forecasting, analysis, financial modeling, business partnering, reporting, and storytelling. And yeah, so in this talk today, really the goal is to give you some concrete pointers about how, as an accountant, you can improve your FP&A skills.
As an accountant, Christian, I do have access to all the data. When I say data, I have access to past data. I have access to present data. I know how much money the company is spending in payroll. I know how much money we spent in the last brand campaign. So how is that information valuable for FP&A?
Yeah, so you can use this information to create a forecast. So for those of you who are maybe less familiar, forecasting in the business context means projecting financial results, that's revenues, expenses, and other metrics that are relevant for the business. And most companies update the forecast either on a monthly or on a quarterly basis. And you can use the data you get from the accounting system to create a forecast, and that creates value in three different ways. One, your forecast serves as a comparator to the business performance. Mm-hmm. So at the end of a month, you compare how do your actuals compare to your forecast, and the difference tells you something about changes to trends, risks, and opportunities. It's the first reason. Second one is a forecast provides an answer to the question about how is the company doing, right? How are we trending? Where are we going? Very important for investors and other stakeholders. And lastly, forecasting helps leaders make better decisions, because a forecast in the end quantifies the output, the result of the decisions in a short, medium, and long term. Essentially, it answers the question of, does this decision make sense? How does this decision impact the financial results going forward?
Yeah, that's really valuable. I know for ourselves, like we just closed the month of October. We just finished our October month in close. And with that month, we were able to determine like what was the value of the campaign that we have run for during the summer. And then to that, I feel like there were a lot of analysis that we had to do between what we had put in a budget mm-hmm. and what the actual numbers were. So can you talk to us about the value of analysis in financial forecasting?
Yeah, so the thing is, when the forecast is done, it's time to do the analysis. And that's where we look at, okay, how do actuals compare to the forecast? And it's important that you do this in a way that you're doing it at the right level of granularity. So let me show you an example. Let me just quickly skip through this. Sorry about that. So let me give you a concrete example for variance analysis. Mm-hmm. Professional fees are unfavorable by 251,000, right? That's the what. Mm-hmm. Then the why is the increase in professional fees is primarily driven by Deloitte, right? Your auditor, 267,000 drives that. I see many finance teams stop here. They think that their job is done when it comes to variance analysis. But actually, it isn't done yet, right? Because what's missing here is the so what. Mm. The so what in this case would be, well, the cost increase isn't due to more billable hours, but rather due to a significant price increase. We should compare Deloitte to other vendors and see if we can find a better one. Mm. Now you have a real insight, because the thing is that if we go back here, if you just provide the what and the why, it's not really telling leaders anything about what they should be doing, right? You need to drill deeper. You need to go deeper into the, ask your business partners, look at the numbers that you don't immediately get from the accounting system, So in this case, you would have had to look at the contract we had with Deloitte and look at how many hours were there, how many hours were tracked. But if you do this additional work, you can uncover the so what, which really makes a big difference, because then you can point to concrete actions. So in other words, how this framework works is the what is about determining the difference between the actual results and the budget.
Mm-hmm.
The why is about analyzing the factors that contributed to the deviation. And then the so what is about interpreting the significance. I often get the question, okay, how do you know you've done enough digging, right? How do you know you've asked enough why questions and you drilled deep enough into the data? And the answer I give people there is, well, check if the insight you have points to one or two specific actions, right? To bring it back here, the increase in professional fees is primarily driven by Deloitte.
Mm-hmm.
There could be a million things, right? It could be that we just the company got more complex, the auditor had more work to do, and so it took longer. Or it could be maybe that we bought additional services that we didn't have in the past, or that we didn't have in the forecast, or that they increased the price, right? There are multiple possible options. But when you get to a point where you can point to one or at most two actions, in this case, the action is, let's do a tender, let's figure out if we can find a better price, then you reached the point where this makes sense. And actually, I wanted to ask you, Edwin, how can RAMP help with analyzing the financials?
So I like this example about the professional service fees, because we currently have different consultants that we use, including auditors, and we use many of the Big Four for our own technical accounting services as well. And with RAMP, I was able to get insight on each one of these firms, like insight about how much money did we spend with Deloitte as an auditor, how much money did we spend with KPMG, EY, and PwC. And we were able to compare like year over year, like the total of the expenses from each firm. We were also able to look at the invoices directly to REP and figure out like how much time they spent on the different sections. So that's one example, like linking what you're just talking about. And I could easily see for myself that the fees were more this year because we have more complex processes. We do have more hours spent on RevRec. So on my side, I'm telling my team, please beef up the audit documentation so we don't have to spend that much money with the auditors. On some other example, for example, I could be like talking about branding or marketing ads. We do a lot of marketing ads at Ramp, for example, and I can see who the biggest vendors are. I know who the vendor owners are. And through Ramp, I can communicate with them directly and give them the insight that this month you spent that much money. Next month, this is what we have budgeted for you. Please stay in line. And what I'm able to do as well is to create spend program for them and to tell them, this is your budget for the month of November, December. And with that budget, you are restricted to these particular vendors that you can use. You cannot use other vendors, and make sure you meet that budget, because the code that I created to a spend program and code program at Ramp can only accommodate up to a certain limit. So RAMP does give insight, but the best action is you can create limits and controls with this insight as well, which I like.
Right.
And Christian, like I know for analysis, like we part of the month-end close process is to do flux analysis. Like, what are the best practices for analysis? Like I know sometimes some companies, they do like at Ramp, we do like month over month analysis, but we also do like budget to actual analysis, like based on the different product type that we have. Like anything that you've seen, like your customers, your clients, like what are the best way to do like analysis?
Yeah, that's a good question. Especially when it comes to comparing forecasts and actuals, it doesn't just matter, what you do after the month is done. It's also super important that you're using the right forecast technique in the first place. Because if your forecast is very shallow, not very assumption driven, then you're not going to learn much by comparing actuals to your forecast. So I actually like to talk a bit more about the forecast and share a few ways that if you select the right forecasting technique, not only does your accuracy increase, but your variance analysis and your analysis process also becomes much more fruitful, because you have the depth necessary to do this right. So when it comes to forecasting, it's important that we combine different forecast methods. At the very least, I always tell my clients and my students, compare have a bottom-up process for doing forecasting and a top-down. So I'll briefly explain those two terms because they're super, super important for forecasting. A top-down forecast starts with the end result in mind. It's about expectation setting. It's typically done by the leadership team or by finance. And it's important that it's not just, oh, we think we should be able to grow 10% next year. That's not a top-down forecast, right? It needs to be more granular than that. So it should ideally start with the mission statement or with a strategic plan. And then you translate that to tactics and do it on the business driver level. So what do we mean by business driver? It could be, are we planning to spend more in advertising next year? Are we planning to launch a new feature or a new product? Are we planning to expand into a new market? Are we doing something with our pricing, with promotions? Those are all business drivers. And the forecast should be done on that level. I'll share an example of that in a moment. And you need to consider not just internal factors, but also external factors. So what the competitors might be doing as a response to what you're planning to do, how the market is going to change, inflation, all that. That's the top down. Then the bottom up starts from scratch. The output is the sum of several sub-plans, and it's about the execution against a given strategy. Because, in this case, you ask the cross-functional team to put their bottom-up plan together. So you might get a plan from the marketing team, from the sales team, if you have one, from the product team, and then you combine them and you add up all these individual plans, and that gives you your consolidated bottom-up plan. And what's nice about doing this is, and how you as an accountant or wearing your FP&A hat can add value here, is you can help understand uncertainty. How do you do that? By asking your business partners challenging questions about the bottom-up that I share with you. And that's also why it's so important that you have a top-down and a bottom-up. Because usually what happens is the top-down is pretty aggressive, so sales are high, and the bottom-up is pretty conservative, meaning sales are low and expenses are fairly high. Why? Well, because it's psychology, right? The bottom-up is prepared by the people who need to deliver the result, right? The business teams. So they want to keep expectations low. While the top-down is created by the leaders or the finance team who are a bit more removed from the business, but who are also often more ambitious. And so there's a gap between your top-down and the bottom-up. But that's actually not a bad thing, because what that means is that you have a fantastic conversation starter. You can take your top-down, you can walk over to the CMO and say, look, I see you told me that you think you can expect to drive this many subscriptions to our product. Our top-down has a different number, and here the assumptions I used for the top-down. Can we sit down and compare where our assumptions differ? That's a completely different conversation than if you just walk over and say, oh, I think your number looks low. I think we can do more, right?
Yeah.
Because it's data-based. And then you have the top-down and the bottom-up. And I wanted to show an example of a forecast technique for a top-down that I personally like a lot. And that's called driver-based forecasting. So a driver-based forecast connects business drivers with financial outcomes. So what you see here on the screen is, on the left-hand side, there are business drivers. So for example, we want to increase the unaided awareness of our product. So how prospects recognize our logo, our brand. We could think about increasing our marketing budgets. There's an assumption for inflation, a new promotion strategy. What happens if we do nothing? And this was from a few years ago where we had to still take into account, okay, now that COVID is over, how does that impact the numbers? And then what's nice about driver-based forecasting is, so what you would do is you list the drivers, and then you estimate how a change in, say, marketing expenses results in a change in sales. And what I like about this is that it forces you to understand the business. It forces you to be really close to operations and what the strategic objectives are and what the company is planning to do differently, because you can't list 50 different things here, right? It should be maybe 10 to 15 drivers at most. So you need to get an understanding of what are the things that matter? What are the levers that we're trying to pull that really should move the needle? And then you can turn that into a scenario planning process. That's another way of how you can add much more value with your forecasts. And that's where we have a conservative, a balanced, and an aggressive scenario. And what's nice about that is that, let's say the balanced scenario is far off, right? This doesn't get you to the expectation that leaders and investors have. In that case, you can say, well, let's take a look here. Unaided awareness increase. We've done a lot of research here. We have data scientists looking at this, and we are confident that we can go with the aggressive scenario. Direct response budget increase, marketing budget increase. I don't think we can be bullish here because, we've done a lot of that in the past and we probably have diminishing returns. So let's stay with the balanced scenario. And so you can quickly fine tune this. And then what's cool about that is that you can clearly communicate the amount of risk you're taking. So when you present this to, say, the board, you can be very clear about where you're taking risks and where you're playing it safe. Super important. And then to bring it back to your question about how can you improve your analysis, this can be a living, breathing document that you update, every month you look at the numbers. Because then you compare actuals versus forecast. And based on what you're seeing, you're going in and you're adjusting individual lines in that driver-based forecast. And then you can just keep updating it. You don't have to update every line every month. You just update it where you have news. And then it's a really efficient way to keep your forecast up to date as well.
So that's a rolling forecast. That's what they call rolling forecast, right?
So a rolling forecast is when you're projecting always the same period. So typically companies forecast until the end of the year, right? Until the fiscal year closes. Now we're in November. If your fiscal year ends in December, you're only forecasting 2 months. A rolling forecast would forecast always 12 months or 18, whatever you choose, no matter where you are in the year. So if I do a rolling forecast, I would now forecast from November all the way to October 2025.
And what is the period people usually forecast for? I see sometimes people forecast 3 years, 5 years, 18 months. Like, what is the right period to forecast for?
Great question. So most companies forecast at the very least until the end of the fiscal year, because that's usually what investors ask for. You share the number with your budget. The budget is your commitment. And then you need to update leaders and investors about how you're tracking against that commitment. That's what the forecast is doing. But then ideally you want to forecast farther out, because especially, now we're in the beginning of November, some companies are probably still in the middle of budgeting at this point. And so you don't want to leave your other departments without an idea of how much they can spend in January and February, ideally, right? Because they probably have to sign contracts already at this time of the year. And so if you have a forecast that goes farther out, then, you can give them some idea of how much they might be able to have to spend. But then there's also long-range planning. And so long-range planning is typically 1 to 5 years out. And that's important because some of your decisions have a long-term impact. So for example, if you're planning to launch a brand new product, it may take a significant amount of time until you start with an MVP and then you add features and you're only going to break even 3-4 years later. Or you have a big capital investment where you're buying servers or equipment for your machines, and it's going to take some time for the capital to really deliver the results you want. And so you need to have a long-term plan, especially also, and the accountants here know this, the way the capitalization works for capital investments. They can be capitalized over 10, 15, 20 years. And while that's not a cash impact, you still want to model out how that impacts your P&L, depending on when you do which CapEx investments. And so that's another reason to do strategic long-range forecasting. The important thing to keep in mind is that the way you do it doesn't have to be the same. So in other words, you may use multiple different techniques, top down, bottom up, to forecast the next 12 months. You pay a lot of attention, you put a lot of time and energy into that. But then for the long range plan, you're probably only doing one relatively straightforward top down forecast. Bottom up doesn't make much sense there because the information just isn't there. So you might be spending a bit less time there, but the key is to focus on the big strategic decisions that can really move the needle.
Okay, I have a silly question, Christian. Like, people often confuse operating model with forecast. Like, what are the differences between the two?
So an operating model. Yeah. So an operating model is typically, your three statements, your P&L, your balance sheet, your cash flow connected, they're dynamic. And you may be doing some forecasting there already, right? So you may be projecting each line in your P&L and your balance sheet out for the rest of the year. That's forecasting at a very basic level. Ideally, you combine that with a driver-based forecast that takes you out of the numbers, because the risk with just projecting your operating model line item by line item is that you don't connect operational metrics with your financials, right? Because it's easy. If you have the data in a spreadsheet or in a tool, you can just project what it would looks like. You can do that in a few minutes if you have a well-built dynamic operating model. But it doesn't really force you to connect strategies with tactics, with action plans. And I think that that's really where you can add a lot of value in finance by going to that level.
Okay, thank you. I know like a lot of people are currently in their budget season and they cannot do it on their own. Like, as accountant, sometimes we have to partner with different departments. So how do people, like, how can we approach this? Like, how do we partner with different partners, like, to get a really, really good forecast?
Yeah, so business partnering is one of my favorite topics to teach, because when you are helping other people in the company make better decisions, it's just super rewarding, right? So when it comes to business partnering, I look at it this way. So business partnering, really, the goal is to be a strategic partner driving sustainable growth and profitability while managing risk. And the managing risk is important. As an accountant, you need to wear your hat of conservatism. You need to make sure that you're reporting the number in a conservative manner. But as a strategic business partner, you also want to point people to the risks that are worth taking, right? You do your analysis, you do your modeling, and then you say, okay, we should do this big bet. It's expensive, it's risky, but we should do it, right? And to be an effective business partner, you need empathy and business acumen. Empathy, not in the sense that you need to sympathize with people's feelings, but you need to be able to put yourself into the shoes of your cross-functional partners and understand what they care about. And business acumen means you need to know enough about the business that you can connect operational results with financial metrics. And at the intersection of business acumen and empathy, you have the four key roles of the business partner. You have raising accountability, pointing to what's driving performance, super important. Otherwise, you can't learn from your past as a company. Simplifying and questioning, because it's super important as well, because people have to deal with more data typically than any executive can reasonably process. So finance needs to simplify it by pointing to the metrics that matter right now. And they also need to ask the right questions at the right time to help people think outside the box and challenge assumptions. And creating visibility means a good finance business partner is always on the lookout of, okay, what are new metrics that I am not tracking yet that could help my business partners maybe get an early read on changes to trends, which then can help them make better decisions simply because they have more time to make those decisions. And then lastly, it's also about influencing and empowering, because sometimes, or often actually, departmental incentives can be narrowly defined. So for example, the sales team may be incentivized to sell as many products as possible, irrespective of which products have a better profitability than others, right? And because you in finance see the entire P&L and you can do the product analysis, you can influence them to maybe sell the products with higher profitability more than others. So those are the roles of the business partner.
So how can we work better as accountants with FP&A, for example? I know myself, when when we had our first FP&A person studying at RAMP, we sat together and I pretty much changed the mapping of my chart of account so I could provide better data to him.
Yeah, it's a great question. So as an accountant, you're typically early in the value chain, right? And in the decision-making chain, let's say. You're the ones who are making sure that the numbers are accurate, they're in line with accounting principles, and they are trustworthy, right? And then FP&A takes those numbers and they interpret them and they then turn them into a forecast. And so how you can make that easier for FP&A is ask them about what they're doing with your data. Ask what happens after you send them your reports, because you may discover that they have to do a lot of manual changes or massaging the data. And then you may realize that, oh, now that I know this, I can give you the data like that easily. I can just pull a different report from the ERP and you have it exactly how you want it. And then you can save them a lot of time. Also, sometimes FP&A doesn't know how much depth is there in the data. How much can you drill down, for example? What is the account hierarchy? And you as an accountant know that probably much better than them. And so you can advise them of, oh yeah, you want to do this kind of analysis. We actually have it by legal entity as well. And this is how the legal entities work. This is how profit centers work. And then you can help them a lot that way as well.
Okay. And my next question is related to sales. Like sales people, they tend to be extremely optimistic. And their forecast might be like 10 times what a conservative person would forecast and measure for. So how do you reconcile between sales or maybe between product engineering, between what they would want and what is actually going to be reality?
Yeah, so in my first role at P&G, I actually dealt with that a lot because I was finance business partner to the sales team, and the sales team was always overly optimistic. And so what I learned over the years, what works best is, first ask them about their methodology. Try to understand how did they come up with the numbers. Maybe you can point them, to a different way of doing it. So you talk about the how, not about the fact that they're over or under. And then the other thing that can make a big difference is see if you can do a back of the envelope calculation where you just estimate sales at a very high level and bring that to the salesperson and say, look, you're arriving at 1 million in sales. I did some quick back of the envelope math. I arrived at 1.3 million. Can we compare assumptions and can we see, maybe where I'm off in my back of the envelope calculation?
And which accounts do you think are most challenging to forecast for? Like which department you think like it's extremely challenging to forecast for?
So it really depends on the availability of the data and how well the the business understands what influences that data. I don't think you can generalize it, but sometimes you have certain P&L lines, certain departments, certain accounts where we just don't know why the numbers behave the way they do, because there's so many external factors that play a role, and then it can be difficult.
Yeah, and talking about external factors, like we just went to an election, and we know there are going to be a lot of changes. What advice would you tell people trying to budget and forecast, thinking that there might be a lot of external factors that they cannot control in their budget and forecast?
Yeah, so if you are going into a period of a lot of uncertainty, the mistake that I see finance teams make is, oh, there's a lot of uncertainty, I need a more complex model, right? I need to add much more factors. I need to, out-engineer the uncertainty. That usually doesn't work, because when you add additional layers of complexity, additional assumptions in your model, you also introduce more error, because each of those can be off. And especially if there's more uncertainty, sometimes the different layers are interdependent. And so the error doesn't just add up, it can multiply. And so what I advise finance teams to do in this situation of a lot of uncertainty is to keep the model as simple as possible, run it for a month or two, see how it does. And if you get a good handle on that part of the business, then, add additional factors, add additional variables, but try to keep it as simple as possible.
Okay. And then my last question, how do you think finance team or accountants can become influencers?
Yeah, so the more influential you are, usually that's driven by how much you know about the business. You need to know more than just what you work with every day. You need to know more than just the numbers you're looking at, because otherwise you can't really influence others. Because the most important thing about influencing is that you understand where they're coming from, you understand the challenges, you understand what they're working on, what they're trying to do, what they're trying to change, why they're doing things the way they're doing them. Really important. So you have to get out there, you have to talk to your business partners. I always recommend, as a first step, see if you can join one of the meetings they have anyway every month, or every week, where they review the business. Just ask if you can sit there. You don't even have to contribute anything or ask any questions at the beginning. Just, get exposed more to how your business partners think. And then you can start at some point, asking challenging questions, and you'll see that your influence grows.
And I will add to that as accountant, we do have a lot of influence and power, and sometimes we don't know it. Like, we control the accounts payable process, we control the billing process, we control the month-end close process. We even control payroll sometimes. So we see everything. And we can use that information to have influence and to have power as well.
Absolutely.
And use it as a way to bridge the gap and reach other departments and other leaders. Just like go to them and be like, oh, I saw that last month you spent, I don't know, $10,000 on this recruiting company. Why did you do that?
Exactly.
So I feel like sometimes accountant can be a little bit shy to do that, but we have the power because we pay the bills, we pay the resources, we do the booking. So use the information that you have on your computer that you booking to get that influence sometimes. So any last word from you, Christian, before we get on the questions that we received from our audience?
No, it's just that, forecasting, planning, analysis, it can be a lot of fun too, especially when you see that the work you're doing, like you said, influences decision-making. That really is, I think, where this becomes really fun. And I hope that, what I shared today helps you in getting at least a little bit closer to that goal.
Okay, that's good. So we have a lot of questions, and I will start with Brett. So Brett is curious to hear your thoughts about modeling for CAC, which is customer acquisition cost for startup with long sales cycles.
So if you're a startup with long sales cycles, then I assume you're probably in the business to business space, right? And so when it comes to business forecasting, so customer acquisition cost is sales and marketing expense, right? And you want to make sure you differentiate between short-term and long-term investments. That's the first step, because some of the investments you're making in sales and marketing aren't intended to immediately result in a sale, right? Those are the investments you do in your brand, in your long-term. So it's helpful to look at those separately and just make sure that you're not spending too much or too little on the long-term piece. Then you look at your short-term customer acquisition cost, and typically what I recommend people do is compare your customer acquisition cost to your LTV, your lifetime value of the product. So the total value that's generated by a subscriber until they end buying from you. And so then you can see, are you spending enough, or are you spending too much, right? Typically, growing companies go for a 3-to-1 ratio, 3 LTV, 1 customer acquisition cost. And if you're far off from there, maybe it means that either your marketing dollars aren't working hard enough, or maybe you're not spending the right amount in the right places.
It's good to know. Thank you for that answer. Patricia asked, she works for a not-for-profit, and she asked, if you don't have any forecast built for a not-for-profit, where do you start?
Great question. I would start by I would start simple, right? Make sure you have your house in order first. Make sure you understand your data. Make sure your data is clean. You know, tools like Ramp really help with that. And make sure that you have everything in a spreadsheet. And then see if you have some seasonality in your business. You know, maybe certain grants, you get those in certain times of the year. Consider that, and then see if you can, based on what you know about seasonality, based on what the business was doing in the last 3 to 5 years, see if you can make a simple projection. And then I would actually take that forecast and go with it to one of your cross-functional business partners who is responsible for the space you're forecasting, and say, hey, I put this forecast together. Do you think it makes sense? What do you think? Because when you haven't done a forecast before, it's easier for someone else to respond to something you have done rather than going to a business partner and say, oh, can you just create a forecast from scratch? You know, that might be tough. That might be very difficult for them. But if you do at least, you know, a preliminary forecast, bring it to them, you can have very good conversations about that.
That's good. So simplicity is key here. My next question, I do have the same question sometimes. Like, do you typically forecast for the balance sheet and cash flow statement, or you just forecast for the P&L?
That depends, right? So for sure, cash flow forecasting is super important. I don't think there's any business who doesn't do cash flow forecasting in any way, because that's how you pay the bills and how you know whether you have enough money to make the investments you need to make. So you absolutely have to do cash flow forecasting. When it comes to the balance sheet, you know, it depends. You probably don't want to spend as much time on every line item in the balance sheet as spend the same amount of time on all the line items. You want to make sure which metrics really help leaders make better decisions. You know, it could be things like daily sales outstanding, right? You need a balance sheet for that. Or, you know, working capital. Because those are the things that leaders can use for decision making. And what I would recommend actually is, instead of forecasting everything and seeing if people find it useful, ask them, you know, ask, how are you looking at the business? What kind of decisions are you making? And then you can see, okay, which metrics in the balance sheet do I need to forecast to help them make those decisions?
That's good. Thank you for that answer. Next one is, how do you educate department leaders when working on forecasting and budgeting? And Stacy said that she often get answers about, like, saying, I don't know when that will happen, or I'm not sure how much it will cost. So how can she educate them so she can get like more accurate answers from?
So yeah, so if you have a situation where you need to forecast something and people just don't know, right? They can't give you an input. What I would recommend is do a break-even analysis. We don't have enough time for me to walk you through, but you can Google that, because with a break-even analysis, you can say, okay, let's say we don't know how much sales this new project will generate. No one can tell me that. So I just look at the cost for making this product. And then I look at how much sales do we need to have for this to break even, right? For this to have a positive profit, or a net present value, if you're doing that, a discounted cash flow of 0. And then you take that sales number you calculated back to the team and you say, look, this is what we need to achieve in the next 3 years to break even by the end of 3 years. Is it feasible? And then they usually are able to immediately say, no way we can sell that much, right, in 3 years. Or, oh yeah, that sounds pretty feasible. And then you have a starting point for your forecast.
Okay, I think we have one question, and this is Jeff asking, what is the best way to develop financial KPI for a business that does not currently monitor these KPIs, specifically for non-public entity in the professional services industry?
So I assume the question is about how do you decide which KPI to track in the first place, right?
I think so.
So that also, you need to start from the strategy. So you understand what the strategy is. You ask, okay, what are the tactics you're implementing to achieve that strategy? Usually that involves making certain investments. And then you work backwards from there. You say, okay, now my job is to measure, is this tactic successful or not? So you ask, what does success look like, right? And then you build the metric around that. So I think it's really, really important that you start with the strategy and the tactic before you do the measurement, rather than coming up with a bunch of KPIs and hoping that they will be useful.
So I'm thinking about that as well. I think it's probably good to think about what you're selling. Professional services, you're selling your time and you're selling contract. So maybe think about like, what's the value of the contract, like contract value, like time bills, or I don't know, like efficiency rate, realization rate. And those are the things, like I remember when I was at PwC, this is what I was looking at. So maybe those are like some basic KPI that Jeff can use when he's thinking about what KPI to use.
You start with the business model. You start with how do we make money? What do our customers care about? And how do we deliver that, right?
Exactly. And just start with the P&L. Like, how do you classify your P&L? Like, P&L is just like service billed, hours billed. So those are the key KPIs that you should have as well. Another question is, someone asked, how can they make the transition from FP&A from controller to CFO?
Okay, yeah, that's a question I often get. There are different pathways to the CFO, right? It's not just that you need to have 5 years investment banking experience and then do 5 years in audit and 5 years in controlling. No, it's not. There's not one set path. Actually, just a few months ago, interviewed an executive recruiter in the finance space for a training program I'm doing. And he said that, a CFO can come through the investment banking route, can come through the accounting route, because, accounting is the foundation for so much in business. And if you understand that, then it gives you a lot of confidence as a CFO. But then CFOs eventually also need FP&A experience, because in the end, one of the biggest tasks that you have is tell the financial story of the business to the board, to investors. And so FP&A experience can help as well. And actually also, you don't necessarily need to be a CPA or a controller to become a CFO. If you can also, and the recruiter said that as well, he sees it more and more, that sometimes people also come through the business side and the FP&A side into the CFO role. So there's no one size fits all.
Okay, one last question before we conclude.
Sure.
This. I know this is the big question. Do you foresee AI having an impact in FP&A, and what will be the impact of AI?
Yeah, so we are at the very beginning of generative AI, right? Machine learning has been around for a long time. It's also part of AI, and it helps with forecasting. So I don't have a magic crystal ball. I don't know what's going to happen. But what I think is likely is that the manual tasks will go away. So things like number crunching, things like consolidation, things like creating spreadsheets from scratch, things like copying things from a spreadsheet into a PowerPoint, even drilling into the data and getting a specific cut of the data manually, all of that will go away. And so FP&A teams have more time to do higher value tasks like business partnering, like influencing, like storytelling, like financial modeling for decision support. And that won't go away because you always need someone to translate what AI is saying into business sense, into which decisions we're want to make, and then convey that to the broader team and connect it with all the data you have access to.
Thank you, Christian. Any last comments, notes?
Thanks so much for having me today, Edwin. I had a lot of fun talking about this. I hope that came across. And yeah, if people want to learn more from me, they can go to fpaprep.com. I can also put that in the chat if people are interested. So fpaprep.com. Yeah, and thanks so much for having me.
Well, thank you for being with us and sharing all the knowledge. That was extremely good, and I learned a lot. I'm sure the audience learned a lot as well. So if people are interested to learn more about RAMP, they can visit ramp@ramp.com. They can also email us at hi@ramp.com. And what does RAMP do? We help you save time and money. We have different functionalities like for cost savings, Spend Insight. We save time to employee. We also save time to accountants. So feel free to get in touch with us. Christian, again, thank you for your time today. It was my pleasure to spend that hour with you. I learned a lot, and I'm probably going to sign up for your course at some point, maybe after my audit is done. Thank you again. Bye, everyone.